You've also jumped into the mega cap exposure business here. You've launched an ETF that holds the top 20 ETFs, top 20 stocks in the S&P 500. You launched another one, the top 30 NASDAQ 100. So NASDAQ 100 is not enough. Now we have the NASDAQ 30 that you launched. I know mega cap tech concentration has paid off. But why do you think the public is going to keep pouring more and more money into the biggest companies? What's the I mean, it seems like this is a late play to me, but maybe I'm wrong. What is your thing?
There's kind of two different things happening. One is if you look at the end investor space, a lot of people in the United States still just don't have stock exposure. They don't know where to start. And I think if you can bring out a fund that gives them exposure to names they know, that they understand, maybe they interact with in their everyday lives, that's going to give them comfort to step into the markets as a stepping stone into ultimately building a broader portfolio. So in some ways, it's an on-ramp to ETF investing. The other angle is looking at professional investors who frankly over-diversified and have missed out on a lot of this Mag 7 rally because they have so many other exposures beyond it. They want a precision tool to dial up and down their mega cap exposure, and this is a very efficient tool for them to do.
But is mega cap really an asset class? Like tech is an asset class. Mega cap tech dominates it, but is Lilly and Berkshire, is it an asset class?
So it is in the sense that they do tend to have performance characteristics as a group. And so for that reason, I'm with you on that you need a really sharp tool if you're an allocator at an institution and you want to fine tune that mega cap exposure up or down, long or short, totally with you. I'm not sure I buy the on-ramp to ETF investing just because we're talking about a very under-diversified portfolio. And, the math would suggest going back hundreds of years, something like 25 to 30 stocks is the minimum requirement for a diversified portfolio, but that assumes that you're agnostic across industry. Yeah. You can't say that about the Mag 20 or the Mag 30 here.
Because it's so hyper-concentrated in tech.
They're very hyper-concentrated in tech.
Yeah. So is the average investor too concentrated? I mean, this is sort of a broad intellectual question. But
if you read things like the subreddit for ETFs, you will find people absolutely want to get very concentrated because they're really speculating. They're not thinking about their 10-year time horizon, they're thinking about their 2-month time horizon. And absolutely, these kinds of products are great for making those kind of speculative bets. I'm reluctant to tell a lot of people their initial 401k effort or their initial IRAs should be into something that's 20 stocks versus say 500 or ITOT and buy the market.
Well, for sure, they're giving people, BlackRock's giving people what they want. I mean, 100%. The flows have still been great.
Of course.
It's not like everybody's like abandoning big cap.
And if I could comment on that for a second, what you've seen is 20 years ago, the entire U.S. equity markets were about $15 trillion. Now that's the top 8 companies alone. And what you see is a lot of these top 8 companies are web services companies, they're also consumer discretionary companies, they're cell phone companies, they're also services companies. When you buy into this top 20, you're actually getting a really wide range of companies and services. They also have their own corporate development arms that are investing in a lot of smaller companies. You're getting diversification in these top names. What it's helping is a lot of investors who are either not invested, or if they are investing, they're picking one of these names, and it moves them into a much better portfolio.
The basic idea is the big are getting bigger and continue to get bigger, except historically it's been hard to stay in that top 20 and top 30.
So math would tell us that if you've had a really great run at the top of the index, you're headed for pain. That's just how that's worked over time. I do think it's worth thinking that it might be different this time. We're in a very different regulatory regime. We're in a very different political regime. Corporate power is more relevant than it's ever been up and down the regulatory food chain. So betting against mega caps, I think, is a tough thing to do. I'm not sure going even more into mega caps is the right call.
It's a different world, isn't it, than 20 or 30 years ago? I mean, it's an asset-light business now. These companies, it's software that they own, and intellectual property like Lilly has. It's not, giant industrial, pieces of machinery and things like that. The whole nature. This is why I think it's possible for the S&P to have a higher PE ratio, 22, whatever it is going forward now, than it was, 20 years ago. Maybe it was 15 was the average. Maybe we can have a higher PE ratio if you have an asset-light series of big companies now whose primary ownership is software and intellectual property and not machinery, for example. So,
well, I think that's been true since the dot-com boom, right? That's when we first saw intangible value being what drove PE, and now we've got, MicroStrategy at a 2,000 PE. So there's no question that innovation tends to drag that PE higher.
Okay, so let me move on. We've had a couple of themes here. AI, talking about top 20. How about infrastructure investment? This is one of your themes. BlackRock's had it as a theme for 2025. The Infrastructure Investment and Jobs Act, remember that one? In 2021, that was the largest infrastructure investment project in U.S. history. $1.2 trillion to build and repair bridges, airports, waterways, public transit. Tell us about, I know this is one of your themes, you have ETFs for that. Do you think that's going to continue? It seems so, because most of the money hasn't been spent yet in this
That's a big
bill.
part of it. So the bill passed in 2021, but you think about they have to identify the infrastructure projects, do some design work, do some environmental work, and then you get the green light to start putting shovels in the ground. That can take years. When the shovels are in the ground, that's when a lot of the money is being spent. So we're starting to see a lot of these projects really start to enter that construction phase where a lot of dollars are going to be spent building new infrastructure, repairing existing infrastructure. What I would say, though, is a lot of people want to kind of tie this to election results. Infrastructure is one of the areas that has some of the most political consensus. And this is important because infrastructure is not just about the president or at the federal level. This happens at the local level, this happens at the state level, and it happens at the federal level. And it happens with public-private partnerships where you have private companies involved too. So you really need a lot of consensus up and down the government and with corporations to support infrastructure.
That's a good point. I mean, nobody's going to argue to repeal the Infrastructure and Jobs Act,
Well,
right?
they will
I don't think there's going to be a lot of support to do that.
They will for political points, but they'll just rebrand it and we'll do the same thing. So I'm with you. I think that we're going to continue to see this kind of investment. It's not really an option. We all know how desperately needed. I mean, it was a joke for years. It was Infrastructure Week for 12 years or something, right? So we know we need the investment. We've got the pathways now to get those picks in the ground. I think the money will be spent. I think it's a great place to look for a little bit of a targeted thematic investment.
Now, explain the differences here. We're putting up, if you could put back that full screen of the three ETFs. We obviously asked for investments here. Can you make the distinction here of what's going on? Are these active or passive, index-based? And what are you owning? Just very briefly with each.
Yeah, so these are all index-based ETFs, and they're touching on different parts of the physical economy. So you have infrastructure, where you're building new roads and highways and airports. You have manufacturing, which is building more factories that can build goods in the United States. Think about, we're building some fabs to build semiconductors in the U.S.
And that's made, here it is.
That's made, and then finally you have ITB, which is the home construction. You have a huge demographic tailwind with the rise of millennials and them earning their peak earnings years that want to buy homes. 86% of renters say they would like to own a home but can't afford it. So you have a lot of just construction happening around the country right now, whether it's infrastructure, factories, or houses.